Hi guys, it's Zhang again from Moolahwise.com. In today's video, we'll be answering the question, what is universal life insurance and how does it work? First, we'll be discussing the history of universal life insurance. Then we'll be using a graph to explain universal life insurance. And finally, we'll be discussing some of the pros and cons of owning a universal life insurance program. So let's get into it. So universal life insurance came out in the 70s, and it is the second iteration of permanent life insurance. And when I say permanent life insurance, just remember that permanent life insurance is just cost of insurance plus cash value, or the savings component of a life insurance program. The cash value in a permanent life insurance policy works the same, where a portion of your premium goes into the cost of the insurance and then the rest will go into the cash value. Universal life insurance came out because consumers didn't want to pay a fixed amount for their entire lives. So the insurance company came out with a universal life insurance which offered flexible premiums. Rather than paying a fixed premium for the rest of your life, in a whole life, you can pay more or less depending on your situation in premiums in a universal life insurance program. Since the premiums in the universal life insurance were flexible, then the death benefit of a universal life insurance program were also flexible, meaning that the death benefit of a universal life insurance can go up or down depending on how much premium is paid and for how long. With a universal life insurance, a consumer can even skip a few months without paying the premium as long as the consumer had enough cash value to cover the cost of insurance for that month or for that quarter or for that year. However, keep in mind that the amount of premium you pay will affect your cash value accumulation too. Compare that to a whole life where the death benefit was guaranteed as long as the consumer paid their fixed premiums for their whole lives. Similarly, in a whole life insurance, a consumer can earn anywhere from 2 to 4% on their cash value. On the other hand, in a universal life insurance, there are no dividends. So let's see what that looks like on a graph. So this is a graph depicting how a universal life insurance works with flexible premium. On the x-axis, you have the life of the program, and the y-axis is your money line. As you can see, and this orange line represents the cost of insurance. As you can see, the cost of insurance goes up as you age, while the x-axis shows your flexible premium. So in some months you could pay more, you could pay less, you could pay more or less. And with the flexible premium, how does this work? So this works like this. In your earlier years, you pay a lot more, and which will help you pay your later years. Is depicted by this graph, where your money goes to pay your cost of insurance in your later years, and then same thing similar to in my whole life video. It shows the graph neutralizing the cost of your insurance as you age. So now that you see what that looks like for cost of insurance versus flexible premium, now let's look at what are some pros and cons of owning a universal life insurance program. The first pro of owning a universal life insurance is that you don't have to pay your whole life, and the premiums are flexible. Fixed rates is another pro, is that you get a fixed rate of return, anywhere from 2 to 4% on your cash value. And some universal life insurance also provide a minimum guaranteed interest, but you got to check with the universal life provider. And so some of the downsides of owning a universal life insurance is that there are no dividends. And another downside of owning a universal life insurance is that the death benefit may not be guaranteed because of the flexible premiums. Finally, the last downside is that there are other faster cash accumulation life insurance programs available that can yield higher rates of return. So in conclusion, universal life insurance is a second iteration of permanent life insurance. It is very similar to whole life, but it is more flexible than a whole life program. Some of the similarities it has with whole life is that it has a fixed rate of return anywhere from 2 to 4% on your cash value. And so that's it. I hope you learned the pros and cons of owning a universal life insurance program. We have a mission of educating 1 million families on how money works and the importance of protecting your hard-earned wealth with life insurance. If you have any questions about life insurance, please reach out to me at info@moolahwise.com or learn more at moolahwise.com. Thanks for listening. Bye.